Michael, simplify asset management is really growing in the ETF category. I think you have over 12 billion in assets or something right now. What are your thoughts about what's going on in the active versus passive ETF world right now? Because you kind of have a battle.
Oh, we absolutely have a battle. And what I highlight to our investors, our actual investors in Simplify itself, is that while we have been really successful, we launched in 2020, we've grown to just over $12 billion, as you highlighted. The simple reality is that for all the growth of active management that we're seeing in the ETF space, it's really a quantity of funds measurement as compared to the dollar flow. That continues to be totally dominated by passive inflows.
When ETF investing started out, it was all passive. What do you ascribe the rise in active ETFs to? Why is it so big all of a sudden when for a long time passive ETFs were enough?
Well, the simple answer is there was a regulatory change. So in 2019, there was something we called the ETF rule that facilitated the creation of ETFs, creating a definable set of objectives. And then in 2020, September 2020, there's something we called the derivative rule that really has been the source of much of the diversification you've seen in active ETFs. That facilitated the inclusion of derivatives. That's what allows 2x levered ETFs. That's what allows call overwriting strategies, et cetera, into ETFs. That was my background. That's what brought me over into the ETF space from the hedge fund world. And it really is what's powering the growth in active ETFs at this point.
All right. So how does Simplify Asset make things simple for investors? You like that, right?
I do like that. That was the intention behind it. In many ways, a lot of the stuff we do is really complex, so investors don't have to. So we will rebalance portfolios of call overwriting. We will pursue objectives, as I do in a high yield strategy, to protect against widening of credit spreads while allowing investors to participate in the higher returns associated with high yield. We're effectively modifying those returns using derivatives or trading techniques to offer investors a return profile that would come from something complex, but for them, it's transparent, tax advantaged, simple to do.
And where are the danger spots in today's market? Is it in valuations? Is it in private market assets? Where are things dangerous or they're overly complicated for investors where you're offering simplicity?
Well, I think that there are several components to that. You highlighted valuations. Valuations are obviously a concern. Much of my research work is actually around the impact of passive investing and how that influences valuations. Unfortunately, I think there is a direct link between the two. And so we've created kind of a demon of our own design. Within the private markets, there's obviously questions about how properly marked the assets are. Are they being offered to retail investors at exactly the right time when we're seeing liquidity constraints in the private space? Within Simplify's framework, we try to just stay away from that. We focus on liquid products. We focus on making products accessible to investors and as much as possible bringing expertise to the management of those products so that investors don't have to worry about it quite as much.
You mentioned demons. Do we have a problem in the indexes right now when you have the Magnificent Seven making up a third of the S&P? Is that a big problem? And what could happen because of it to investors? Is it dangerous?
Well, the simple answer is passive investing is not passive. The definition of passive investing means you never buy, you never sell, you only hold. That means you can't get into markets, you can't get out of markets. It doesn't actually exist. When everybody invests in the same way, it creates bubbles. And the simple reality is we are experiencing a passive bubble that will ultimately correct itself. Unfortunately, it'll likely be somewhat violent in that correction.
So finally, let's carry on that theme. What should investors do if you see a violent bubble popping sometime in the near future? When's it going to pop?
Well, the quick answer to that is we don't know exactly when it's going to pop. That's what's called a stochastic outcome. It's going to depend on a lot of other things that are occurring. What we increasingly know, though, is that it is going to pop. I actually have an academic paper forthcoming in the next couple of weeks that highlights the outer limits of how far we can get. We're getting frighteningly close to those levels. The simple answer, unfortunately, is that this is not a problem for the retail or individual investor to address. It's what's called a systemic risk. It's non-diversifiable. If you step outside the market and try to invest in assets that are quote unquote not related, you will discover that other people have done so in a levered fashion using the collateral from the higher valuations from their underlying assets. It's not something you can really protect yourself from. And so part of what I try to emphasize to people is the Chuck Prince line, the music is playing, you got to keep dancing. But unfortunately, we know that the party is getting old.
All right. Well, thanks for coming on and talking about it.
Thank you very much.